Hi, good evening, everyone. We wait for another 5 minutes.
Yep. Can you
Okay.
hear me, Nami?
Hi, Mr. David.
Okay, I'm back
Okay.
with a slightly different view. I think the video is going to be working, but this lighting is a bit different.
All
Uh,
right.
okay.
Okay, shall we start?
Okay, I think we are good.
All right. All right. Okay. So, yeah. Good evening, everyone. So, thank you so much for joining us tonight. My name is Naomi from Vivo Malaysia. So, hope everyone is doing great today. We are excited to have Mr. David with us to share his insight tonight. Good evening, Mr. David. Thanks
Good
for being here
evening.
again. Yeah, thanks for being here again. So for today's sessions, we'll be exploring trading strategy for CME WTI Crude Oil future with Elliott Wave Theory. Right? Okay, next. Right. Before we get started, let me quickly go through a short disclaimer. Everything shared during today's webinar is for educational and informational purpose only. Any market view, strategies, examples, or opinions shared by our speaker represent his personal perspective and should not be taken as financial advice or recommendations to buy or sell any investment product. Next. All right. For those joining us for the first time, let me briefly introduce Vibu Malaysia. Yeah. So Vibu is a digital investment platform that provide access to multiple financial market all within one apps. We first launched in the US back in 2018. Vibu has expanded across 14 markets throughout North America, Asia Pacific, Europe, and Latin America. Here in Malaysia, Vibu Security Malaysia Sdn Bhd officially launched in 2024 and is regulated by the Securities Commission Malaysia. We hold a Capital Market Services license under the Capital Market and Service Act 2007. One thing many of our users like about Vibu is that everything you need is in one place. You get advanced chatting tools, technical indicators, real-time market data, and plenty of learning resource to help you along your investment journey. Right. Now let's take a quick look at the future product available on Vibu. Our platform provide access to both Bursa Malaysia Derivative and Global Future Market. For Bursa Malaysia Derivative, you can trade products such as FKLI and FCPO. We also offer for the global future, including equity index future, energy product future, metals, cryptocurrency future, and agriculture future. Next. All right, next, let me highlight some of the key features available on our platform. One of the biggest advantage of Vibu is our competitive pricing. For Bursa Malaysia stock, commission is 0.05% with a minimum fee of RM2.50. For US stock, ETF and ADRs, we are currently offering zero commission trading until 31st of December 2026. Regulatory fee is still apply. For US options, fee is $0.35 per contract. Beside that, user can also trade Hong Kong stock, China A share, Bursa Malaysia future, and global future, all with competitive commission rate. Okay. Beyond pricing, we also offer a range of useful features, include Sharia filters, multi-country and multi-asset trading. We have 24/5 customer support from Monday 8 a.m. until Saturday 8 a.m. Right? We have 24 hours trading enabled. And the last one is the flexibility to choose either you want Islamic bank or conventional bank account for fund transfer. Now let me share some of our current promotions. For our welcome promotions, all you need to do is open account, deposit a minimum of 5,000 and maintain the fund for 60 days. Once you fulfill the requirement, you will be received 300 ringgit worth of trading voucher. All right. We also have our referral promotions. You can invite your friend or family using your personal referral link. Once your referral once your referral deposit at least 5,000, you will receive 100 ringgit worth of trading voucher. So maximum you can invite 5 people. So you will receive maximum 500 ringgit worth trading voucher. So if you haven't joined Vibu yet, be sure to scan the QR code later to explore more reward lah. Another feature we would like to highlight is our 40% intraday margin for Bursa Malaysia derivative product, include the FKLI and FCPO. This allowed like traders to open position using only 40% of the normal margin requirement during the eligible intraday trading hours, give you like more flexibility in manage your capital. All right. The same benefit is available for selective global future product as well. So like eligible product include selected equity index, metals, and energy future, all with 40% intraday margin. Lastly, here is our overview of our global future commission rate. Depending on the product, commissions start from as low as $1.75 per contract with a maximum commission of $5 per contract. All right, everyone. So that's all from me. If you have any question about today's topic, feel free to type your question in the chat and we will go through together later. Without further ado, I would like to hand the sessions over to our speaker, Mr. David. Right, Mr. David, over to you.
Thank you, Naomi, for that fantastic promotions that we see on board there with Webull. Very, very exciting. And welcome. Welcome to this webinar on Elliott Wave reading. Okay. So before we get into that, I will just quickly share my screen.
All right.
Okay, I hope it's rendering well for everyone. Just hold on me while we connect to the screen. Okay. How is that looking? I hope it's rendering well.
Mr. David, there's still like a black bar there.
Okay, just hold on a second.
No worries.
Yeah, we have a bit of technical issues just now on the sharing. Okay, I'm just going to switch off my camera just to just check on the bandwidth. Okay, just hold on a second.
No problem.
The audience first, hold on. Have a bit of patience with us.
No worry, take your time.
Yeah, today's evening we have a bit of this, what do you call that? Okay, I want to switch off my camera first so that to save the bandwidth, and then I'm going to share again. Okay, let's try again. Now that's to think about IT. Hopefully this is good. Are there still some of those gray bars on the screen?
Yes. There's still some.
Just hold on. I get this sorted out. What I could do now is, okay, while we sort this out. Okay, what I like to do is this. Okay, let me stop sharing. Okay, I'm going to quickly, okay, what I'm going to do is I'm going to quickly send Webull the copy of the slides, right? So that it can be projected on Naomi's screen. Then we can talk through that while our internet gets better over on my side. Okay, so I'm gonna quickly send a if you'll just have a bit of patience with me, I'll just quickly send this to Naomi, and then we can get this session going.
Okay.
Thank you for everybody's patience, and guarantee you, if you stay, it's going to be a good session for you. Hold on just a second. All right. Okay, while I'm sending that to you, I just wanted to say that this Elliott Wave analysis and Elliott Wave reading is one of those advanced techniques in terms of technical analysis. And it's one of those techniques we can actually use to forecast markets. Okay, what do you mean by forecasting markets? Basically, in terms of forecasting markets, what we mean is we can use it to actually see into the future, kind of like look into the fortune of the future. Okay, a lot of technicals like the ones that we normally use, you can only use it for like trading the immediate current trend, right? So let's say, for example, if you're trading moving averages, or even if you're trading fractals and all that, you can only trade it in the current what do you call that time frame and the current moment, okay, as the market moves in front of you. Whereas in terms of Elliott Wave, you can look out in the next week, in the next month, in the next 6 months, and the next few years. So that's the beauty of Elliott Wave as a what do you call that a tool for forecasting. Okay, hold on a second. I'm gonna get you this in a short bit. Yeah. Okay. I'm
Mr. David, you send to my email, is it?
I'm sending it to your WhatsApp. Is it all right?
Okay.
I can send to your email as well. Let me send one to your WhatsApp first. Okay.
I try to open in WhatsApp first.
Okay. I'll send one as well to your email.
Let me try.
So that's why it's a very different tool, considering how it is used. Okay, so Elliott Wave could be a very, very complicated what do you call that subject as well. Okay, if you delve for those, I'm sure this is something that some of you have delved into. Those who actually join this session would probably have some background on Elliott Wave, right? If you have, it's helpful. If it's not, then what we're going to do tonight is we're going to really simplify the whole process of reading the Elliott Waves. Okay. Naomi, do you have it?
Yep. Yeah, I'm trying to open it.
Okay. Okay, I'll send one to your email as well. PDF copy. Okay, so while we work out the
David, you are sending me the PDF copy, is it?
Yes, PDF copy.
All right, so we will project as a PDF copy, yeah?
Yes.
All right.
So tonight I'll need Naomi to work harder for me. She's going to be the one forwarding my
No worry.
my slides. Okay. Thank you everyone for your patience.
Mr. David, can you see the screen now?
Yes, I can see. I hope everybody can see as well. Do you want to like enlarge it to full screen or something?
Okay.
Can that be done? I think there's a full screen mode up there. Okay, I think we're good to go.
All right.
Happy to see everyone is also seeing the same screen. Okay, thank you for still staying there for me. Okay, all right. So tonight, okay, the the title is actually to decode the next trend in the WTI crude oil. Okay, so specifically tonight we will have examples, and we want to look at what is the trend of WTI crude oil. Okay, and we will be, of course, applying all the Elliott Wave techniques. Okay, not only in trading crude oil, but we will also look at all the different types of markets. I want to give you as many examples as possible so that you can actually use it to analyze any market at all with Elliott Wave theory. Okay, let's move on. Okay, so that's me. Okay, what do? I'm a full-time trader, and I also run a consultancy for financial markets education, and also have services to the corporate clients who need financial markets training and education, as well as consultancy. So, well, some of you may know me. I've been in the business for the last 30 years in Malaysian listed derivatives business, right? So I've the latest was the last 3 years. I was running a proprietary trading firm in Malaysia. And just a quick one. Let's move on. Okay, this is a disclaimer. I think Emily already covered that, so we'll move on. Okay, so this is what we will cover this evening. Okay, number one, understand where does this Elliott Wave theory comes from, and actually what has it got to do with market psychology. Okay, one of the most interesting aspects of Elliott Wave theory is it's basically reading the market psychology, because the market psychology goes through certain stages. Okay, and those stages are actually reflected in the waves in the Elliott Wave. Okay, so we look at market psychology, all right, and connect it back to Elliott Wave. Okay, and then we look at the Elliott Wave theory. What is the 5-3 basic wave pattern of an impulse and corrective waves? We also look at the fractal nature of waves, okay, and the waves within the waves, okay, which is a very interesting aspect of Elliott Wave is the fractal nature. So Elliott Wave can be used for different time frames, okay, depending on your trading horizon. It can be used to forecast the next hour. It can be used to forecast the next day's movement. It can be used to forecast the next week, next month, or even the next couple of years or months movement. Okay, so that's why it's very interesting. So there is 3 cardinal rules in wave counting. We'll look into that. These 3 rules are the rules cannot be broken in terms of reading and counting the Elliott waves. And very closely related to Elliott waves is also the Fibonacci. We use Fibonacci relationships to actually measure. It's a measuring tool for the Elliott waves. Okay, then we'll talk about momentum and divergences. We'll also talk about one tool. Okay, we'll be using certain tools to make our job of reading an Elliott wave easier. Okay, so these tools were not available during the founder's time. RN Ralph Nelson Elliott in the 1930s. He didn't have the computer. He didn't have the indicators that we have now. So we're going to use some of the indicators to make our job a lot easier than his time, actually, in the 1930s. Okay, so we look at things like alligator. We look at momentum indicators like the AO, the Awesome Oscillator. And these couple of tools will make it a lot easier to make your reading or your identifying the waves a lot easier. Okay, so then we go into practical Elliott wave counting, where we look at some examples and also the case studies and apply those techniques that we learned tonight for the WTI crude oil futures. Okay, so please feel free to answer, to ask any questions. I'm really be glad to answer questions across the next session. All right, let's move on. Okay, so the first part is to understand market psychology and the Elliott Wave theory. Let's move on. So when we look at a market, okay, and this is a scene from Chicago trading floor, okay. This unfortunately don't exist anymore, okay. But as close as the last 10 years, this was still available on the Chicago Mercantile Exchange trading pits, okay. But basically this encapsulates a lot about what a market is, okay? Because you see a lot of people there, shouting their buy, sell orders. These are the traders on the pit, right? Fulfilling their clients' orders and also trading for themselves, okay? So in terms of looking, definition of a market is basically it's a crowd of people placing bets or placing their views about where the market is going, right? Some of the people will be thinking that, oh, this particular asset is going up, okay? Gold is going up or crude oil is going up. But you have on the other side, the one is willing to sell you is the one who feels the otherwise. So he feels the markets are going down, okay? So this crowd of people, when you go into a big crowd, okay, when there's a lot of orders going in, that is the one that constitute a market, right? So the futures market is an aggregation of a lot of people, different views about where the market is going. All right. So let's move on to the next slide. So the interesting thing is when people go into a crowd and become a part of a crowd, okay, they tend to change their character, okay? And this is something that you may find yourself interesting. Those of you who have traded before and traded for a while, okay, you realize that when before you actually go into a trade, people say you're kind of quite normal, okay? But after a while, when you're already in the market, you will feel a lot of emotions, okay? You go into this crowd psychology thing. And then there's this very famous book, okay? It's called A Study of the Popular Mind, The Crowd, The Study of Popular Mind by this Gustave Le Bon. And he says that when the man gets into a crowd, he basically loses himself. He's not functioning as an individual anymore. Okay, he becomes something like a robot, and it's very easy to be guided or accept a lot of ideas from the crowd. Okay, so when you are in the market, you tend to have all these emotions. Okay, and a lot of people are joining you in these emotions in terms of the ups and downs of the market. Right, so that's the interesting thing, and all this will reflect in terms of the Elliott wave. Okay, let's move on next. Okay, so when you're looking at Elliott Wave Theory, you're basically reading the investor psychology, okay? So it's the crowd psychology, the crowd that makes up the market, okay? That's what you're actually reading, okay? And because the Elliott Wave Theory looks at the market behavior, okay, and there is a certain pattern, okay, when the originator of this idea and this theory, Mr. Elliott came out. He saw in his charts, he saw in his data, and saw its commodity and stock market charts that there is a very familiar pattern that keeps on repeating, okay, and this finally came up with his observations in terms of the Elliott Wave Theory. Okay, so in the Elliott Wave Theory, as you can see on the page there are 5 waves. Okay, there are 5 waves, and it's basically these 5 waves constitute an Elliott wave. Okay, with 5 impulsive waves, and they are followed by 3 corrective waves. And Elliott wave theory is actually used to analyze financial market cycles. Okay, there is a cycle, right? A cycle of, and all these cycles are related to emotions. Okay, and so we use this to actually forecast the market trends. Let's move on. Okay, so we saw just now that there are 5 waves. Let's say, for example, if you are in the bullish impulse wave, there are 5 bullish impulse waves. Okay, and each of these particular waves have a particular investor psychology. Okay, so I'm going to run through you all the 5 waves and the 3 corrective waves, and what is the underlying investor psychology behind it. Okay, so let's first look at wave 1. Okay, so wave 1 tend to be the wave that starts the directional change in the trend. Okay, so wave 1 is always the first wave in terms of the directional change of a trend. Okay, so this could come. Okay, so although we're analyzing this on a bullish a wave upwards, okay, it's the same for a bearish market as well. So to make it a bit easy, we'll just concentrate on the bullish market first, okay? So in terms of looking at the wave one will be the start of perhaps a downtrend already, okay? So a downtrend moving and transforming into the next bullish wave, okay? So we will start with what we call wave one, okay? And in terms of wave one, a lot of people are not convinced of any what you call it, of movement in the market, okay? So in this phase of the market, you tend to see a lack of interest, okay? Some of you may be investors in equities, okay? So there's a time when there's a lull in the market that a particular stock or a particular market has basically, people have lost interest, okay, maybe the market has gone into a bear phase, and now there are a lot of people who lost money in the market, and basically people just set aside, not thinking about that particular stock or not thinking about the particular markets, okay, and then suddenly there is there's this move called wave one, okay. It seems like a calm, regular market, okay, nothing much has changed. You will believe, those people who don't really observe how the markets move, they believe that it's just a normal thing, okay. So wave one is just a beginning or happening. Okay, let's move to wave two. Okay, and because wave one, everybody thinks it's normal. Okay, so those traders who are actively trading in the market, basically they have seen basically a market perhaps that have been consolidating. Okay, so they believe that the market may be continue to be moving on the sideways market. Okay, so what you do is after the wave one upwards, there'll be a sell down in the wave two. Okay, so every time the wave one goes to a particular high, it'll be sold down. Okay, so all the traders who are trading in wave two, they find, hey, quite easy. I just buy the low and sell the high because it's consolidating. It's a range trading market. Very easy to trade. Okay, so range traders love the wave two market because it's consolidating. There is a kind of a recognizable high and a recognizable low, so they'll buy the low and sell the high and continue to do it until the market becomes very different. That's going to be wave three. Okay, so this looks like a regular range trading market with a bit more market activity. Okay, it's interesting. Market has a bit more volume coming in it, but the traders continue to believe that the market will be stable around here. Okay, and then the wave three move on. Okay, wave three is where, although the market is moving very strong, wave three is the strongest acceleration. So later when we look at analyzing a market, we will look very closely at wave three, because wave three has a very particular psychology and a very particular characteristic in its momentum. Okay, and wave three is actually the strongest wave in any bullish or bearish wave. Okay, but a lot of people still don't believe. Okay, so you can see the red comments there. Some traders will be saying, hey, no, this is too high, this is not justified, no, something seems to be wrong, there should be a reversal. So every time they'll try to sell. Okay, but as they try to sell, it continues to move up. Okay, continues to prove them wrong. Okay, so at the last phase of the wave three, okay, they will be convinced, okay, that this is a new trend. Okay, this is where actually wave three is where the smart money is. Okay, that's where smart money and smart traders, okay, those of you who recognize a wave three, this is the most best wave or the best phase of the market to trade, because it's so trendy, it's so strong, it's going in one direction. Okay, so you want to really be able to recognize and catch a wave three. Okay, later we'll see how we do that. Okay, but there are a lot of believers. Okay, so for those who are less knowledgeable in markets, or for those, a lot of retail traders, okay, they don't get an action in the wave three. Okay, they actually get an action later. We'll see which wave. Okay, so wave three will make everybody, wow, can't believe that they're so strong, this particular market, right? Okay, let's move. Then after that, there'll be wave four. There'll still be people selling. Okay, then all the sellers and say, wow, wave four, okay, finally the market is going down. It's proving me right. Okay, this is something that I told you guys already. This market is going down. Okay, so at wave 4 is relief. Okay, but wave 4 for the smart money, wave 4 is slowly already taking profit. Okay, so the wave 4 is characterized by a very hesitant market. Okay, there's a fight between the bulls and the bears. Okay, and this is rather difficult to analyze. Wave 4 is one of the most difficult waves to trade and also to analyze. Okay, and you see good selling also coupled by a bullish trend. Okay, so those who are selling just now in the wave 3 now finally believe that the wave 4 now the rise or the trend has stopped. Okay, and then what will come next is wave 5. Okay, so wave 5 is where it's euphoria. Okay, it's where everybody say, wow, this is now finally I believe that this is an uptrend. Okay, we are getting to wave 5, and wave 5 is actually the final leg of the bull. Okay, and that's only where a lot of people get excited, especially the retail market. Okay, if you know how to read the waves, you will know that wave 5 is now the last leg of the bull. Okay, but wave 5 is still a very tradable wave. Okay, it still gives you a very good trend, but it's slower than the wave 3. Okay, but in terms of the psychology of the market, okay, this is euphoria. They are really very, very happy. Nobody wants to be a seller in this market. Okay, so it's a bit explosive. There's a very clear direction. Everybody say, okay, and now we believe that the market is up. Okay, this is crazy. Okay, but there's nothing we can do. It's only going to go higher. Okay, but it's very interesting. Remember, this wave 5 euphoria is actually the last and final leg. Okay, so it's the leg where everybody on the road is talking about, say, Bitcoin. Okay, when Bitcoin is 100 over 1,000. Okay, it's where stock markets at this peak where everybody, including your fish vegetable seller, is also trading the stock market. Okay, so if everybody's saying or so excited about markets, this is usually already the last wave. Okay, now after the 5 impulsive wave, we are going to go into the corrective wave. Okay, let's move on to see the corrective waves. Okay, next. Now we move into the ABC corrective wave. Okay, now this is where a lot of the retail players will be caught. Okay, because some of them may have not caught the wave 5. Okay, all the excitement there, they did not catch it, or they did not dare to catch it, did not dare to chase for it. Okay, so at this wave A, which is the down wave, when markets are correcting downwards, okay, they will say, oh, good, this is the best time for me to buy. This is a chance to buy more. Okay, so this is where a lot of them will be caught. Okay, most of the buyers will be caught at this one. Okay, and wave A is actually optimism. Very, very funny. Right, as the market coming down, this is what do you call that? Optimism. Okay, but most of the smart money would have already exited at wave 5. Okay, so now we're left with the not so smart money. Okay, I don't want to say dumb money, but not so smart money. Okay, and the markets are thinner because the large players are already slowly exited already. Okay, but it's all this retail or the last players in market saying that this is exciting. Okay, this is going to be the best. I'm going to make a fortune. Okay, because he's so convinced about the trend, right? And then it will go to wave B next. Wave B is where the guy will say, yeah, I told you. Yeah, here we go. We are going up to the next bullish phase again. Okay, I told you. He will tell his friends, I told you. Okay, this is the false hope stage. Okay, those players that were got in at wave A, this is where it gives them the false hope that market is still going up. Okay, some actually like to buy more. Okay, but they're already long already. Those who want to buy already committed totally already. Okay, and you want to sell, so now it's too low to sell already. Okay, there's no buyers to push up already. So after wave B will come this wave C next. Okay, wave C is where everybody says, okay, it going down so much that everybody will say die already. Okay, so all the people will resignation and say, okay, this market cannot play lah. I'm not good for the stock market, or the stock market is not cannot play one. And this is where things get disorderly. Everybody is throwing the positions. Okay, everybody is running out of market, and wave C is a very violent wave as well. That's why wave C is another wave that traders like to see if they like to trade, if they know that the wave C is coming. Okay, so you can see in the different stages of the wave, it reflects the investor psychology. Okay, and then there's a wheel called the investor emotional view wheel. Today I don't have it. You can Google it, investor emotional wheel cycle. You can see all the psychology behind it. Okay, so these are the psychology behind each of the wave. Okay, so now let's get in and get into more of the Elliott wave. Let's move on. Okay, so let's look at what Elliott wave is. Okay, its fractal nature and its wave degrees. Next. Okay, so this is the handsome man here. It's Ralph Nelson Elliott, okay, born 1871. He passed away in 1948, okay, so he's the father and the founder of the Elliott Wave Theory, okay, which basically his theory is there is a orderly pattern, there is a repetitive pattern, and this pattern is like a wave, okay? That's why it's called a wave, okay? So that was in the 1930s, right? As we move on in the 1980s, as the IBM computers came in and the mainframes of the computing, the start of the computing age, okay? We are able to crunch more data. And during that time, okay, this thing called modern chaos theory found that in terms of all the chaotic market movement, there is actually a order of a high degree, just like in nature. Okay, that was what Elliott Wave said as well. Okay, that it's very orderly, right? So there's a very orderly and repetitive pattern. Okay, so modern chaos theory also turning up all the data during the computing, the start of the computing age. Yes, there is a huge order. High degree of order. Okay, so this market, okay, exhibit what we call fractals. Okay, just like in nature, the crowd psychology and the human brain is also a natural, phenomenon. Okay, so it's a fractal organization as well. Okay, so let's move on to the next slide. Okay, what are fractals and what are fractal geometry? Okay, a fractal is basically an ever-repeating mathematical shape. Okay, so what you see over here, it look a bit like a kidney, and then there's a little ball on the left side. This is a fractal structure. Okay, so if you move your eyes to the smaller structure, you're going to see the same thing again. Okay, there's this little kidney, and then there's a smaller ball, and then the smaller little balls attached to it. Okay, this is what we call a fractal. So a fractal is a pattern that repeats itself infinitely, regardless of the scale it is observed in. Okay, so whether you zoom in or you zoom out, each part of the pattern looks similar to the whole image. Okay, so the smaller part will look like the bigger part. Okay, a bigger part will look like the smaller part. Okay, so it's a infinitely repeating pattern. Okay, and mathematician Benoit Mandelbrot basically coined this term called the fractal. Okay, and these patterns can be found in nature, such in branches of trees. Okay, in snowflakes, in leaves, in animals' circulatory system, our circulation, our blood circulatory system, the river system, all has this fractal formations. Okay, so let's go next. So as you can see from the pictures over here, this is a snowflake. The one in the blue is a snowflake, right? So the snowflake is a fractal, of course. You zoom in those snowflake, you will exhibit the same patterns repeatedly, okay, in nature, in plants as well, okay, and also in markets, okay. So you see a picture right down there. It's an Elliott wave. I drew the first part. So the topmost part is the 1, 2, 3, 4, 5 ABC. And within that, you can see within the wave 1 on top, there are also 5 waves, okay? 5 waves and followed by 3 waves down, which is wave 2. And then at the lower level as well, there are the smaller waves, okay? So the Elliott wave is a fractal itself, okay? So that's the interesting part of the Elliott wave. So let's move on to the next slide. Okay, So in terms of the fractal nature of the Elliott wave, this is what we call the waves within the waves, okay, the market fractal structure. So you can see right there on the right side, okay, on the right side, the topmost is the larger wave degree, the middle one is the smaller degree, and the lower one is even a smaller degree. Okay, so in Elliott wave naming convention, there are what we call the grand supercycles, which are the Elliott wave that counts decades. Okay, so you can say decades, a trend in decades. Okay, tens of years. Okay, and you can also see the super cycle, which is measuring the Elliott wave of the several years. Okay, and you have the cycle, which is within 1 year or several years. You have the primary wave, which is between months to years. Okay, so this could be a weekly to monthly chart. Okay, intermediate wave, which is weeks to months. This could be a weekly or daily chart. Okay, and then the minor, which are weeks, days, hours, and minutes. Okay, so in each of the cycles, from tens of years to minutes, okay, every single pattern it repeats and repeats. That's the beautiful and the wonder of actually Elliott waves. Okay, so let's move on. Okay, let's look at the five, a bit deeper into the five impulsive wave and the five tree basic wave. We call this the 5-tree basic wave. Okay, let's move on. Okay, so this is basically the whole architecture or the whole what you call the law of Elliott wave. Okay, so in a bullish market, there is 5 impulsive wave. We saw already 1, 2, 3, 4, 5, followed by A, B, C on the right side. Okay, so the 5-wave movement upwards is and it's unfolding, or it's moving in the primary direction of the trend, and the ABC is traveling at the opposite of the direction. Okay, that's why the ABC is considered the corrective wave. Okay, so all this again is fractal, so you will see the smaller waves within this bigger wave as well. Okay, but this is the basic construct of the Elliott wave. Okay, now if you imagine this particular wave upside down, then that's applicable in what we call the bearish impulsive wave. Okay, so always remember, as we studied, although our convention is looking at it on a bullish market, there is the perfect mirror image of it when it is in a bearish market cycle. All right, so that's something that you need to understand. Let's move to the next one. Okay, so this is the typical properties. Okay, the first 5 waves are called impulsive, and the next 3 waves is called corrective. Next. Okay, now we're going to dive very deeply into this already. Okay, this for all those who attend today's session, this will be given to you as handouts later after the session, so that you can actually use it to guide yourself in terms of looking and recognizing the waves. Let's talk about the characteristics of wave 1. Okay, it's going to go into a bit of a technical lingo. Okay, so those of you who don't understand them, just write your questions and we will get back to you later once we finish this part of the theory, and then we can ask that question. Okay, so wave 1, we said the wave 1 is the change in trend. Okay, so wave 1 is accompanied by one particular characteristic called divergence. Okay, divergence in the awesome oscillator momentum indicator. Okay, and it's right below here. Okay, I don't think I can annotate on this. Can I? No, unfortunately, I can't annotate on this slide. Okay, let's see whether I can. I can't. Never mind. Okay, so this right at the bottom left, you see awesome oscillator. You see this shaded area. Okay, there's this thing called divergence. What is divergence? Okay, later we'll go a bit deeper into divergence. Basically, divergence is as the prices are going down. Okay, as you can see from the left side, from the wave B down to C. Okay, where you see a 0.0, the market is actually coming down. The prices are actually coming down, but but the oscillator or the momentum is actually going up, okay? So you have a trend down here on the left side of the prices, and you have a trend up here at the awesome oscillator, okay? So these are what we call a divergence, okay? And this type of divergence is called a bullish divergence, okay? So a bullish divergence basically is already signaling to you that the market is going to change direction, okay? So you will see a 0.0 there. 0.0 there is where is the start of the wave, okay? So from 0 to 1, that's what we call wave 1. Okay, so the characteristic of wave 1 is there will be divergence. Okay, and this is where you see a change in trend. Okay, that's where we put the 0.0 there. Right, okay, you see the 0.0. Okay, and this is basically establishing a series of trades for wave 1 through to wave 5. This is the sequence. This is the start of the impulsive sequence. Okay, so basically to establish 0.0, okay, you will look at basically a completion of sequence wave C. Okay, so we're talking about wave C here, but we have not covered. Later, we'll cover wave C. Wave C, remember, is the last wave of the ABC correction. So after the ABC correction, it starts a new impulsive wave, and that's where we put the 0 point. All right, so let's move on. Okay, now we come to wave 2. And just now we already spoken about wave 2. Wave 2, not a lot of believers in it. So wave 2 is likely to be sold down quite aggressively as well. Okay, this is what we call the profit-taking retracement. So every once the wave up came up on a bit of a bullish sentiment. Okay, wave 2 are all the traders actually selling it out to take profit. Okay, so wave 2, what it does is basically creating a new selling in an uptrend. Okay, wave 1 is an uptrend. Okay, or if it's a bearish trend, then it's a buying on a downtrend. Okay, by basically traders who do not recognize wave 1. Okay, so they don't really recognize, as we say just now, it's still regular trading. They don't recognize it. Okay, they don't see it as a change of trend, so they continue to sell down. Okay, so a large part of wave 2, about 73% of wave 2 actually retrace between 38% or 62% of wave 1. Okay, so what does that mean? You can see there in the percentages. You can see that at 50% retracement, at 62% retracement, these are Fibonacci retracements. About almost 75% of the time, wave 2 will fall below and retrace back, okay, a wave 1 by 38% or 62%. Okay, and wave 2, okay, it interestingly can even retrace up to 100% of wave 1. Okay, but it cannot retrace below 100%. Okay, but it can retrace up to 100%. Okay, or 99%. Okay, and one of the things about wave 2, if it ends less than 38%, okay, so we are saying that almost 75% of the time you go to 38% or 62%. Okay, but if it does less than 38%, then the wave 2 will be what we call a correction that's very irregular. Okay, it's not going to be a simple correction. It's going to be an irregular correction. Okay, you understand later when we talk about irregular correction. So it's going to be irregular. Basically, it's going to be messy. Okay, that's what it means. Okay, irregular is it's going to be a messy correction. Okay, so it's not going to be a clean like ABC then up back to the next wave. Okay, so wave 2 retracements of more than 62% of wave 1 occur only 15% of the time. Okay, so normally there's a very small percentage of it going below the 62% level, right? So you can see the notation there that it's only 15% of the time that will move to that. Okay, so you normally expect wave 2 to end between 38 to 62%. Okay, and most of the time it will touch the 62% to bounce. Okay, now what is the beauty of wave 2? Okay, because we know that after wave 2 is wave 3. Okay, so if you are able to catch a wave 2 bottom, okay, so you'll be riding basically the wave 3, and when we say the wave 3 is the most aggressive wave, you'll be riding the bottom of the wave 3, and that's very, very, very exciting. Okay, so let's move on to the next one called wave 3. Okay, so this is the wonder to behold. This is the wonderful wave. This is the wave you want to be there. Okay, because the wave 3 is normally the steepest and the fastest wave. This is the wave that you want to trade. Okay, and you can see right at the bottom there, if you catch the bottom of wave 2, you'll be riding almost the full wave. You'll be catching the best wave of all. Okay, and this wave, although in initial times you can some people can mistake, or with the Elliott wave readers can mistake it for fifth wave blow off or self off. Okay, because of its steepness. Okay, some may be misread as a fifth wave. Right. So generally, the characteristic of wave 3 is it's got heavy volume. Okay, the smart money is there, the big players are there. Okay, and there's heavy volume. Okay, so the wave is fast. Now, if the wave is fast and the volume is light, then it's usually not a real wave 3. It's a wave 5 blow off. Okay, so wave 3 is where it's usually the most profitable. Okay, you want to be loaded and in terms of position size into wave 3, okay, because that's where the highest probability of making a great profit is there. Okay, and one of the characteristics of wave 3 is you get a lot of gaps. Okay, in this because market the velocity is so high. Okay, today market close, tomorrow market will open higher and gapped up. Okay, it will open higher than the closing or the high of the previous day. Okay, and these are the signs of wave 3. Okay, so what is the target length for wave 3? Okay, wave 3 is normally between 1 to 1.62 times of wave 1. Okay, it can extend more than that, but it's normally between 1 and 1.62. Okay, so you can see that wave 3 is normally longer. It's usually the longest of the wave. Okay, so you can see the extension there. 15%, 45%. Okay, so 45% between 1.6 to 1.75 of wave 1 is a high probability, and there's also a possibility of a 30% go up to even 2.62 times of wave 1. Right, so you can see this is a very aggressive wave. You want to be here, right? You always would prefer to be able to trade the wave 3. All right, so let's move on. Okay, to wave 4. Now, wave 4 is the toughest wave to trade. Okay, so if you find yourself, if you're a breakout trader or you're a trend trader and find that, hey, my God, my trading is getting bad this time. Okay, you are most probably stuck in what we call a wave 4. Okay, if you don't know Elliott wave, you're stuck. This is a whiplash zone. Okay, 85% all the range and whiplash is going to happen in wave 4. Okay, so you got to ask yourself, let's say, for example, if you're a breakout trader or you're a momentum trader and find yourself always gonna stopped out and all that, ask yourself, okay, whether you are in a wave 4. Most of the time, you are in a wave 4, okay? And that's one particular rule that you need to know, and this is the Elliott wave rule. This is the rule of alternation. Now, if wave 2 was simple, okay? The previous wave 2, what do you call that, was simple. Wave 4 will be complex, sideways correction, okay? Either a flat, irregular, or triangle, okay? Basically meaning messy, okay? So the rule of alternation you need to know. Just now, if the wave 2 was a messy wave, that means it was a complex or irregular wave, then wave 4 will be simple. Right? This is the rule of alternation. And there's one unbreakable rule here. Wave 4, okay, when it comes down, must never enter the price of wave 1. Okay, if it enters into the price of wave 1, something wrong with the count. Okay, it cannot drop below or if it's a bearish wave, that it cannot be above, okay, wave 1 peak or bottom. Okay, so this is one unbreakable rule. Later I'll remind you of the 3 cardinal unbreakable rules of Elliott wave reading. Okay, and this one there. Whenever you find yourself very difficult to tell where you are in the wave count, you can't count, you look at it very confusing, well, it's most likely a wave 4. Okay, and wave 4 is a wave that if we can avoid trading it, the best is stay away. But you have a very high chance of losing money if you're a trend trader in wave 4. Okay, now if wave 4 retraces more than 62%, okay, let's say, for example, you have one wave 3 and you find that wave 4 now is more than 62%, okay, then you'll make wave 5 very, very difficult, okay. Wave 5 will only then have a 10% chance of making a new high, okay. You expect in normal times, wave 5 to be above wave 3. Okay, the next wave 5, is supposed to move through above wave 3. But in the wave 4 actually go down more than 62% of wave 3. then the chances is 90% that wave 5 cannot make a new high. Okay, so this is what we call a failed wave 5. Okay, so let's move down to the last wave. Okay, and this is the two main characteristics you must know about wave. This is the last struggle to create highs, or if it's a bearish wave, this is the last struggle to compared to create lows. Okay, the slope is usually less than wave 3. So wave 5 is definitely not so steep. Okay, so if you see wave 3 very steep, you see the wave 5 not as steep. Okay, that's the characteristic. Okay, now if wave 3, okay, the previous wave is less than 1.6 times the wave of 1. So if the wave 3 is a short wave compared to compared to 1.6 times, there's a strong chance that this wave 5 will be extended. What do I mean by extended? It means that the wave 5 will be longer than the wave 3. Okay, so this is one of the conditions if wave 3 is less than 1.6 times wave 1. Okay, now wave 5 will end between. Okay, the study by Tom Joseph, that wave 5 will end between 0.62 times to 1 time of the length between wave 1 and wave 3 combined, and that added to wave 4. Okay, so you add that length of wave 1 to wave 3, okay, multiplied by 0.6 or 1 time, and you add it to the end of where wave 4 ended. That is the target zone for wave 5 to end. Okay, and wave 5 usually ends in a divergence, and this divergence is called the bearish divergence. Okay, so you have wave 5 prices moving up, but hey, momentum is actually going down. All right, so that is the final struggle. Okay, so if you see that, you know the market is going to go into a ABC downturn already. All right, so let's move to the ABCs. Okay, now I want to tell you about how to simplify your analysis of Elliott Wave. Okay, now we are looking at Elliott Wave for the purposes of trading. Okay, we are not Elliott Wave what do you call that, theory proponents. Okay, basically we want to use the wave to trade. Okay, so later I'll show you why that we want to only trade, okay, wave 1, wave 3, wave 5, okay, and the corrective C. Okay, because just now we saw wave 2 has a potential to go into a messy wave as well. Wave 4, 85% of the time, it's going to be messy. Okay, so you want to avoid wave 2, wave 3, and also wave A and wave B, okay, because these are corrective waves, and corrective waves can be very, very messy. Okay, so you simplify your analysis by basically deleting those things that you don't want to use. Okay, in a sense, okay, you are subtracting the mess from your head. Okay, so you want to look for 1, you want to look for 3, okay, you want to look for 5, and you want to look for wave C of the correction. Basically, you want to take action during that time. Okay, so the accuracy in terms of the ABC corrective waves and 2 and 4, you can have a bit of a good knowledge grasp of that, but you're not going to like pinpoint precision in that, because you know that you're not going to really participate in that. Okay, so that's one of the things to simplify your trading. If you know that it's going to wave 4, you're going to avoid already. Okay, so you just basically look to see where the wave 4 end is. Okay, and if it's going to go into an ABC correction as well, okay, the A and B side is going to be messy, it's going to be tough. Okay, you probably want to see whether the C you can trade now. Okay, as I explained to you the ABC corrective wave, you know why it can be getting complicated. Okay, so one of the first characteristic of ABC, it can be a zigzag correction. What is a zigzag correction? Okay, it looks very orderly. You can see it's like a zigzag. Okay, 5 goes to A, then go up to B, then go up to C. Okay, and the structure is what we call a 5-3-5. A is 5 waves, B is 3 waves, and C is 5 waves. Okay, so this is what we call a simple and sharp correction. Okay, this is probably tradable in terms of the C. Okay, so if you see a zigzag, okay, that's fine. That's probably possible to trade C. Okay, the wave C. Later we'll see. Let's move to the next correction. Okay, another type of ABC is the flat correction. Okay, so the flat correction has what we call a 3-3-5. Okay, that means the A is 3, the B is 3 waves, and the C is 5 waves. Okay, this is a complex sideways. Okay, each wave is almost identical in length. You look at phi to A, okay, A to B, B to C, they're almost of the same length. All right, so this is what we call flat correction. That's why it's called flat. Okay, so the next type of ABC, okay, let me move to a next slide. It's what we call irregular. Okay, this one is a really tough one to read, okay, because the B even goes higher than the wave C. Okay, so once you see the irregular, what's irregular? The structure is 335. Okay, 3 wave on the A, 3 wave on the B, and then 5 waves on the what do you call that, C. Okay, and the B can actually go up higher than the 5th wave. Okay, so the wave B exceeds the start of actually the wave A. Okay, start of wave A is at the end of the wave 5. So this is called irregular. It's very, very messy. Okay, but let's look at characteristic of corrective waves. Okay, we want to kind of look at the similarities of these waves. Let's move on to the next slide. Okay, where we talk about the triangular. Okay, another type. Okay, this one is even more headache. Okay, this one is a large triangle correction. Okay, this is called the ABCDE corrective wave. Okay, this is what we call a complex convergence. Okay, but the prices after you seeing, if it goes into a triangle movement, it will shoot up in the direction of the previous impulse wave. Okay, so if the impulse wave is a wave 3, okay, the top triangle, wave 3, then it will shoot up to wave 5. Okay, whereas if it's a corrective from the wave 5, then it will go into a C. Okay, this is extremely complicated again. Okay, but you can recognize it, but it's kind of difficult to trade it as well. Okay, so let's move on. Okay, so let's look at a diagnostic check. How do you check for which wave it is? So these are the few things that you look out. Okay, how to identify a simple zigzag, which is tradable, versus a complex correction, which you want to avoid trading. Okay, so if wave A contains 5 internal waves, okay, so if you see within wave A, you analyze, hey, wave A got a 5 wave. That means, okay, a tradable zigzag pattern is materializing. Now, if you see a wave 4 contains 3, okay, all these 3, 5, these are the tough ones, okay. So if you see wave A is 3, okay, expect a complex correction, okay. So you can have a flat, you can have an irregular, or you have a triangle. This is difficult to trade. This is something you want to avoid, okay. And note this one very important thing. Wave B always have 3 internal waves. Okay, I say that again. Wave 3 always have 3. Okay, so to analyze when is the end, whether the corrective wave is a B. Okay, the B has to be a 3 wave. Okay, the B doesn't have any other 5 waves. It's only a 3 wave. This is something that you must remember. Okay, wave B always only has 3 waves. If it's more than 3 waves, it's not a wave B. Okay, why it is also important to know wave B is because wave B, the end of wave B is where we want to trade the wave C, right? Remember we said wave 3 is something, wave C is a tradable wave. That's where we want to come in as well. All right. Okay. I hope I've not lost everybody here, because this is corrective wave. Corrective wave is where everybody gets lost, and that's where everybody gives out on reading Elliott Wave. Okay. But if you go by elimination, you say, hey, some of the stuff I'm not going to use. So if it goes into irregular, I'll let it be. Okay. I'll just watch and observe. Okay. But if it's zigzag, then it's something actionable for me. All right. So what is actionable? If wave 5, if there's 5 internal waves in wave 4, then a tradable zigzag pattern is materializing. Okay, let's move on to the next slide. Okay, so this is where you will tell yourself, okay, which are the waves I want to concentrate on? Okay, the most profitable and the most tradable waves. Okay, the best waves to trade is, of course, 1, 3, 5, and the corrective wave C. Okay, this is especially in the wave 4. Okay, if you find a corrective wave C. Okay, but with trading the corrective wave C is tend to be a more advanced. But I think if you consider all the corrective waves, the wave C is the best wave to trade. Okay. Now the caution rule for corrective waves, okay, is not recommending, not recommended to trade wave 2 or wave 4 corrections. Okay, so you're basically trading counter trend, number one. Okay, which is hard to do very profitably. Okay, because you always want to trade with the trend. Okay, so choose not to put too much money or even try to trade wave 2 or wave 4. Okay, but we always like to identify where is the end of wave 2 and when is the end of wave 4, because we want to trade the wave 3s and wave 5s. Okay, so if you choose to trade wave 2, okay, you say, I like to be in the market all the time, okay, against our advice, and wave 4, okay, but stay away from complex correction. Like if you want really to do that, okay, since messy markets, there's no clarity and it's difficult to read. Okay, even for very advanced eliticians, it's very difficult to read. Okay, people get the reading wrong. Okay, so don't spend too much of your time or your effort in trading that kind of difficult. Might as well avoid, relax. Okay, do something. Okay, nicer until the markets become more conducive. Okay, so because this wave 2s and 4s are where whipsaws, and it can actually eat into your capital. Okay, and if you don't know how to control, and if you lose control of the emotions, it's where you lose all your capital in wave 2 and wave 4. So try, if possible, not to be involved in trading the wave 2 and the wave 4. All right, so let's move on to the next slide. Okay, let's talk about 3 rules that you cannot break. Next. The 3 rules that wave counting, in terms of wave counting, you cannot break. If it's broken, not you, the market, okay? If the market breaks this rule, that something is wrong. The wave count is wrong, okay? First rule, wave 2 cannot retrace beyond the start of wave 1, okay? So wave 2 can hit upon 100%, but it cannot go more than 100%, okay? Here it says never 100%, okay? So it can. There are certain times that we go very close to the wave 1 low, which is wave 0. The wave 1, the low is end of wave 1 is the 0.0. That's where wave 1 began, okay? Now, if this happens, if you see that it goes against, then it's a lower low. That means this is not impulse wave. It's a continuation of the previous wave, okay? So that negates the wave count. Okay, the second cardinal rule, wave 3 is never the shortest impulse wave. Okay, so wave 3 cannot be the shortest. Okay, it can be the second longest, but it cannot be the shortest of the 3 impulsive wave. Okay, so wave 3 must be longer than either wave 1 or wave 5, or even both. Okay, so most of the time it's longer than both of them, because this is typically the longest and most powerful wave. Okay, and the last rule is wave 4 can never enter the price territory of wave 1. Okay, so wave 4, when it corrects downwards, it cannot go in the territory of wave 1. Okay, and in a bearish wave, okay, when wave 4 retraces upwards, it cannot go into the territory of wave 1. Okay, so these 3 rules cannot be broken. Okay, these are the 3 rules that cannot be broken in terms of Elliott wave counting. Okay, so always go back to this and ask yourself these 3 questions. Okay, next. Okay, let's look at the Fibonacci. Just now, when we're talking about the different wave characteristics, we saw some of those Fibonacci percentages, right? We're going to look at some of them just to be familiarized. Let's move next. Okay, so these are the key ratios with Elliott waves, okay, related to Elliott waves, okay, and these are actually the mathematical foundations of wave proportions, okay. Now, the interesting thing is all these Fibonacci ratios and all that. These are all your natural proportions as well, okay. Our body, our human body, is constructed using Fibonacci ratios, okay. The ratio of our face, the placement of our eyes, our nose, our ears, the length of our limbs are all this wonderful natural thing created by God. in Fibonacci ratios. Okay, so some of the key ratios, as you may remember, okay, if you refer back to the notes in describing the different waves, okay, wave 2 is normally correcting to 38% to 61.8%. Remember, 73% will come down to that particular retracement of wave 1, okay, and the extensions of wave 3 will be 161% to 261.8% of wave 1, okay. Wave 4, when it comes down, will come down to 23.6 to 38% of the wave 3, okay, and then wave 5 will end up 62% to 100% of the length of wave 1 to wave 3, right? So all these are like the ratios and dimensions of our bodily parts as well, and then it's reflected in the markets as well, right? So again, wave A, 38.2.61% of the previous wave, wave C, extension of 100% to 161% of wave 1, okay? So these are things that you note, and we already noted down in the top section of the notes above, right? So we use Fibonacci to basically measure wave proportions, all right? So target zones and projections of where the waves will be, we use Fibonacci. Okay, so next. Okay, let's talk a bit about the divergence. Okay, bullish and bearish divergence is a very valuable tool to kind of like get an alert on whether the market is already reaching a bottom, ready to turn ups, or reaching a top, ready to turn down. Okay, so let's look at the theory of divergence. We move next. Okay, so in terms of momentum, it's very interesting. It's basically the physics of markets. Okay, so price is the last thing to change in the markets. What does that mean? Price is the last thing to change. Okay, what this means is price is the last thing to change direction in the markets. Okay, yeah. So in terms of how prices change, you see how the sequence is. The trader makes decisions, right? Trader makes decision, and when trader makes decision, let's say for example, a lot of traders make decision, volume will go up. Okay, then the speed and momentum will start to react. Okay, then momentum will start to react, then only price. So okay, so in terms of sequence, decisions, volume, speed of momentum, and momentum, then last only the price. Okay, it's just like the pendulum going up. Okay, so once it swings from one direction, okay, you slowly decelerate. Although it's still going up in one direction, but the momentum is already decelerating and actually changing already. So the principle is this: before any price trends change direction, the momentum must come to a stop, like a pendulum. It must come to a stop and then turn the opposite direction. Okay, so that's how momentum moves, and that's how we want to see momentum. And one of the very good momentum indicators is either, okay, let's move on to the next slide. Okay, either we use this Bill Williams awesome oscillator, okay, awesome oscillator is called AO, or we use the 534.5 MACD. You can, if your system, okay, let's say for example, if you're using TradingView and all that, it's perfectly fine. You have Bill Williams awesome oscillator there already, and this is very important because you want to read momentum of the Elliott wave. Okay, so this is something you want to do. Now, if you don't have that, you can go to your MACD and you can change the what do you call that, the criteria or the settings, okay, of the MACD. Basically, it's a 534.5 MACD histogram. Okay, you calculate it using the 34 bar simple moving average of high minus low divided by 2. Okay, it's very big technical here. Okay, but those of you who can go in, you can change the settings. Okay, these settings are available to change in most of the technical analysis platforms. Okay, but in TradingView and most other platforms, you already have Bill Williams awesome oscillator. Okay, so what the awesome oscillator tells us exactly is what happening in the current momentum, whether the momentum is coming down, okay, or the momentum is going up, okay, as against the price. Okay, let's move to the next slide. So what are divergences? Okay, divergences happen when the price moves in the opposite direction of the momentum. Okay, basically that's the definition. Okay, and divergence forecast. Okay, there's a very good tool as well. It forecasts a potential change in trend. Okay, so this is one of those things that we look for in terms of changing of a trend is divergences. So in bullish divergence, excuse me, what is bullish divergence? Okay, bullish divergence means that markets is probably looking for bottom. Okay, so you have weakening prices. Okay, prices are coming down. Okay, but momentum is strengthening. Okay, it's moving opposite direction. Price come down, momentum going up. That's called bullish divergence. It's alerting to you that there's a possible bottom forming. Okay, and in terms of a bearish divergence, what does it say? Basically, it says that the top is coming. Okay, you have prices that are strengthening. It means prices are still going up, but the momentum is actually going down. Okay, so it's moving in opposite direction. So it's basically alerting to you as a person looking at a chart. Hey, there's a possible change in direction coming because momentum is changing, right? So let's move to the next slide and see what's yeah. So here we have the AO indicator at the bottom panel, and we have prices in a line chart. Okay, you can see on the left side where we see a bullish divergence, the top line, the blue line is prices coming down. Hey, but the AO indicator is going up. Okay, then you see after that, prices started to move upwards. Okay, and as markets started to move upwards, okay, you can see, okay, a divergence already. Markets going up, hey, but the AO is coming down. Okay, and basically what you have there right in front of you is actually the impulsive wave 1, 2, 3. Okay, 3 is always the highest momentum. Remember this, the 3 is the most aggressive wave. So the momentum for the AO is always highest for wave 3. Okay, then it comes down to wave 4. Okay, and then it moves up to wave 5, and wave 5 has divergence. Okay, we already said that wave 5 has a divergence. Okay, and then after it comes down to the ABC, right? So right here, you can see the classic Elliott wave formation, okay, shown to you in terms of momentum, okay? Now, what about that bullish divergence just now, okay? So that bullish divergence was what we said in that characteristic in wave 1, 0.0, 0.0, okay? There's a very high chance 0.0 is where the turning of the whole trend is from bearish to bullish, right? So 0.0 is where you see the bullish divergences. Okay, so in one picture here, with all the divergences, is basically showing you the characteristic of the 5-3 waves. All right, let's move on. I add for you another tool. This is called the Bill Williams alligator. Okay, Bill Williams alligator. Okay, don't worry about all those words right over here. This is indicator that you put on your charts. You just go to that indicator and put Williams alligator is actually 3 lines. Okay, it's actually a 13, 8, and a 5 moving average. Then move towards the future. Okay, so what is this Williams alligator good? Okay, Williams alligator is good for identifying whether the market is on an upward or impulsive wave or not. Okay, impulsive wave or in a corrective wave. Okay, let's move to the next slide so we can talk about that. Okay, so when the indicator is opening, that means its mouth is opening, all the moving averages are far apart. This is in a very trendy meaning what? Impulsive wave. Okay, when prices are inside, okay, or the prices or all the 3 lines are very, very narrow, then this is what we call range bound. And when it's range bound, what does it mean? It's either in a corrective 2, corrective 4, or possibly a ABC correction, okay, or AB correction, okay. So it's good to use the Williams alligator to see which phase of the market is, okay. It's a good way to read the what do you call that, the characteristic of the Elliott wave using an alligator as well, whether it's an impulsive wave or in a corrective or consolidation range bound wave. Okay, let's move on. Okay, so now I'm going to give you some case studies, okay, and we will look at some of the wave counting, and these are also some extracts from previous presentations I've made for CME, and where I use the Elliott Wave for counting and looking at the market direction. Okay, so let's move on to the next slide. So before we get into that, I want to teach you the process of counting the wave. Okay, the first step is this. Okay, in order to count the wave, you need to look at 100 to 140 bar frame. Okay, what does that mean? Okay, if you're looking at a daily chart, okay, you need to measure back from the current chart, current bar, 100 to 140. So you're zooming into the area of 100 to 140 bar. Okay, that's a golden rule. If you do that, then you have perfect clarity of the wave count. Okay, now if you are under 100 bars, that means you are too zoomed in, you'll be measuring the Elliott wave of a very large degree. Okay, and if you are too zoomed out, you're looking at 300 bars. Okay, then you're measuring Elliott wave for multiple smaller degrees. Okay, so for the ideal way to count, start with 100 to 140 bars. Okay, so this is very, very important, and this is the golden rule of counting. Okay, because you cannot count the waves accurately without the correct context. So the context have to be, you need that 100 to 140 bar context. Okay, so you basically adjust your chart, okay, to display 100 to 140 of these bars. Okay, hopefully after I finish, I can get in and my I can show you real-time charts. Okay, let's move on. Okay, that's first rule. Next, okay, now this is the process. Okay, first apply the golden rule of 100 to 140 bars to get the context for analysis. The next step is look for wave 3. How to look for wave 3? Okay, wave 3 is the strongest and most identifiable wave, right? That's the strongest wave. And wave 3 has this characteristic that the momentum, or the AO, is the one that is the largest momentum. Okay, so look at AO and see. Confirm with alligator, AO, and also Fibonacci, and also divergences. Okay, that's the third step. Okay, then apply the 3 cardinal rules. Remember that? The 3 cardinal rules. Okay, and then also look at your alligator. Is it telling you confirming as well? Okay, and lastly, are the Fibonacci ratios also in the correct order? Okay, so this is the whole process. Okay, first remember, okay, set the time context, 100 to 140, look for wave 3, okay, which is the highest momentum, okay, then confirm the rest. Then you can, from the wave 3, pull back to the back to see the wave 1, okay, then you can look forward to see the forward waves as well. Okay, let's move on. Okay, let's look at case studies now. I'll show you some examples, and then I'll run through you. Next one. The first case study is gold, and this is in August of 2021. Okay, this was what I did in my presentation in 2021. Okay, this is a weekly chart, which at that time I said, gold hopes to scale new highs. Okay, and if you can see there, what is the price of gold? Gold was under 2,000 US dollars that time in 2021. Can you imagine? It hit a high of 5,000 over this year, right? Okay, so let's look at the chart, and you see wave 3 there, all right? You see the notation wave 3, and you look at the bottom, right? Can you see that wave 3 has the highest momentum of the AO? Okay, remember this, wave 3, highest momentum. Wave 4, okay, wave 4 has one characteristic you must know. Wave 4 must go below 0 if it's on a bullish wave outside, okay? So we have a wave 3 with the highest momentum in terms of AO. Then the AO must move below the 0 line to confirm wave 4. If it doesn't move below the 0 line, it has not confirmed wave 4, okay? So in this chart, the momentum has gone below 0, you can see. So that confirms wave 4, okay? And after wave 4, what is the wave coming after wave 4? Then wave 5, okay? So that's why I wrote there in notation, okay? Now let's move back to the previous one first, okay? I note that in notation in the yellow box. That's, yeah, okay, thank you. So in the yellow box, you can see, okay, wave 4 for gold appears to have completed the bottom of the crucial 62%. It landed at 62%, the crucial retracement zone at 1650. Okay, so so now, okay, it's going upwards. Okay, on a wave 5, right? Yeah. So this is the reading in gold for August 21. And now we've seen that the prices are even higher now. Let's move on to the next one, Naomi. Okay, this is gold in June of 2026. Okay, so this is the current view, almost the current view. Where is gold now? Gold is trading at about 4,001, right? So what wave are we in the current wave? Okay, obviously that wave that took us to the high of 5,000 over is a what? It's a wave 3, right? Very obvious. You can see the momentum right at the bottom. Okay, wave 3, and now is the momentum after wave 3 has hit below 0. So now it's confirming that this is already wave 4. Okay, so wave 4 have three targets. Okay, one is 4,050 levels, the other is 3,006 level, and the other one is 3,002. Of course, that's a very extreme wave 4. Okay, but remember this: the wave 4, when it comes down, cannot break the wave 1. But wave 1 is very far away from here. Okay, so as of June 16, we can read from the Elliott Wave chart, okay, that gold on the weekly chart is in a wave 4 correction. Okay, next. Let's move on. Okay, so Dow Jones. Okay, this is June 9th this year. Okay, so basically about a week and a half back. Okay, what is the wave now? Okay, let's look. This is very classic. I've written down the wave 1, wave 2, wave 3, wave 4. Let's look at wave 3 first. Okay, so wave 3, you look at the AO is at the highest. Okay, then wave 4, the AO moves below 0, confirm wave 4. And then what's wave 5? Okay, wave 5 goes up, but you can see basically the wave 5 momentum and the wave 3 momentum is flattish. Okay, this already is the first sign of a bearish divergence. Okay, and it also has a double bearish divergence here, right here. Okay, now what we are seeing here is basically wave 5 is doing a kind of an extended wave. Okay, we call it a bit of an extended wave. So at these current levels, for Dow Jones, around the 52,000 level, it's a very critical zone. 51,500, 53,000 is a very critical zone. Okay, this could basically point to the last part, our last target zone for wave 5. Okay, so basically what we're saying here in the weekly chart of the Dow is in the final stage of the wave 5. This is the final leg of that bull run. Okay, so the next after this is what? Okay, next will be the ABC correction. Okay, that's why this bearish divergence in momentum suggests that it is toppish. Once it tops out, a large degree corrective ABC wave should unfold. Okay, so this is a reading on June the 9th. Okay, let's move on to another case study. The next one is crude oil. Okay, now we're going to apply in crude oil, and this is July 2021. Okay, my God, July 2021, it was trading only the $50-$60 range. Okay, I've what do you call that, drawn certain lines for you, and you can see wave 3, the first line arrow down, which is the highest momentum. Then wave 4, momentum goes below 0. Okay, then wave 5, you see prices went up to a new high, but there is bearish divergence. Okay, so you can see all the 3 waves here. Okay, there's also a wave 1 which is not displayed right over here. Okay, so when I saw this chart, daily chart in July 2021, basically I'm saying the bull phase already completes the 5-wave Elliott 5, the correction will come in play. And you can see the first indication of wave A is already there. Okay, so this is basically a classic read of CI and CL, the crude oil chart. Let's go next chart. Okay, next chart is July, the following month in July 22nd of 2021. Okay, okay, basically here, okay, the chart basically read that there is going to be oil prices above 100. Okay, and in this particular time, oil has not broken above 100 at this time, right? So basically in July 22nd of 2021, I wrote, okay, weekly wave structure suggests prices above 100. Okay, that's why the title is Life Beyond 100. Okay, because I was projecting a wave 5 from here. Okay, let's move on to the next one. Okay, so this is last year, October 2025, before the war started in January of end of January this year, 2026. You see that oil was doing a very, very long. It was from 2022, the high of wave 3. You can see the momentum high, right? And then it started to consolidate so long, okay? But the beauty of this is the wave 4 never actually go below the wave 1 high. So it actually conformed to the to the three what do you call that unbreakable rules, the three cardinal rules of wave counting, right? So the wave 4 low right here around the 50 over levels, the 55 to 58 support zone actually didn't break below the wave 1. Okay, so and there's bullish divergence right here, basically calling this bottom. Well, it was a very, very long-winded. This is characteristic of a very triangular A, B, C, D, E kind of a correction. Okay, and then a bit of a small wave 1 showing. Okay, this one is where nobody would believe. Okay, probably now a wave 1 or wave 0 starting in October of 2025. Okay, so that's what I wrote, bullish wave 5 to commence with the completion of wave 4. Okay, so what we're seeing now, okay, let's move on to the next slide. Okay, so this is June 04. So you had the war coming in, and then prices striking up above the 120 levels. Okay, so that is wave 5 coming, right? This could be extended. Okay, this is very special because it's also together with fundamentals that we have never seen in history, right? So this could possibly be an extended wave as well. Okay, so this is wave 5. So oil, you can see the projections here. There, oil could reach 140, oil could reach 191, and those are projections. Okay, one-time projection for wave 1 and 1.618 Fibonacci is 191. So you hear people talking about $200 oil per barrel. Okay, these are already in the Elliott Wave chart. Okay, showing you that already. So that's one of the amazing things about Elliott Wave. It's basically forecasting things that somehow will come true. It's very, very strange. Okay, it's kind of a very strange thing. But that's why it's such an amazing tool, right? Let's see. Let's move on to see whether we have other charts after this. Let's move on. Okay, we don't have charts already. Okay, but let's talk a bit about the CME crude oil futures chart contracts. Okay, let's move on to the next. Okay, so in order to trade CME crude oil, you have basically two contracts. The big brother is called the WTI Crude Oil, CL. Okay, this is it's a 1,000 barrels contract, which is a very large contract. Deliverable. This is basically the US oil. Okay, so this is the US oil that Trump talks about. Okay, and this is why Trump says that in the US he has more than enough oil. Okay, they're actually having a record-breaking production. Okay, oil in the US, which is WTI light sweet crude oil, is basically at all-time highs. Okay, and that is an amazing thing. That's why he says that I have a lot of oil. Okay, but the thing about it is oil is transacted in international markets, so it follows international price. So although the US have a lot of oil, it still follows prices. So if prices are going up, WTI still goes up. Okay, because this is the global benchmark for oil prices. Okay, the other contract, which is the next slide I show you, is the MCL. MCL is the smaller contract, and we as individual traders, or if you are a retail trader, this is a more manageable contract to trade. Okay, it's 100 barrels. It's 1/10 the size. Okay, margins are also relatively more affordable to trade this contract, and this is what we call a cash settled contract. So there's no delivery. Okay, the big brother, the CL, actually is a deliverable contract. Okay, so it's a 1,000 barrels. If you didn't close out, and then your broker also forgot to do close out for you, then you end up with 1,000 barrels of oil per contract. Okay, so this is a great contract to trade the MCL. Okay, so if you're looking to trade WTI for the very strong movements that the WTI will have, okay, but what is interesting just now as you read the Elliott Wave, okay, for the Elliott Wave to go to 140 to 200 means what? Okay, it really means that the world is not a very nice place to be, especially in the Middle East, okay, because that will mean that whatever the current ceasefire that is being negotiated or the MOU that is negotiated will fail before, if not, then why would oil prices go up there, right? So we don't know. We got to see, right? There's still a projection for wave 5 in crude oil as far as Elliott Wave is concerned. Right, let's move on to the next slide. Let's see what we have behind this. Okay, so this is the key takeaways. Okay, we're going to wrap up the key principles of what we learned tonight. And hopefully I'll try to attempt to see whether I can share my browser with you. Hopefully I can do that so that we could at least have a practical session. Okay, now the key takeaways is this. Okay, for Elliott Wave, it's a 5-3 wave pattern. Okay, this is about the collective psychology of the market. Okay, basically the crowd psychology. Okay, number 2. Okay, 3 cardinals you cannot break. Remember, okay, because these 3 rules validate your count. Okay, can you remember the rules? Okay, yeah, wave 2 cannot break below the wave 1 origin. Okay, you can go to 99, 100%, but cannot break through without that. Okay, then wave 3 has to be the wave 3 cannot be the smallest wave, okay? It cannot be the shortest wave, okay? It can be the second shortest, second longest, whatever you say, okay? But it cannot be the shortest, okay? And the last third cardinal rule is wave 4 cannot go into the territory of wave 1. Okay, these are unbroken. If it's broken, your wave count is most probably already wrong. Okay, so waves are fractal patterns. So if you see the wave in a weekly chart, okay, there is a chart in the daily chart that has a wave as well. Okay, and within that daily chart wave, there is the hourly, the 4-hourly, the 15 minutes. Every single time frame has got its own Elliott wave. Okay, and if we use Fibonacci ratios, okay, to measure, it's a tool for measuring the wave proportions, whether it's a correction or it's a correction down to how many percent of the previous wave, or it's an extension of the next wave. Right. So the alligator, if you use the alligator, it will tell you when to trade. Okay. The Elliott wave tells you where you are. Now, this is a very important principle that I want to talk to you. Okay. So the usage of Elliott wave. Okay. Can you use the Elliott wave to time it to the minute or to whatever? A lot of people try to do that, and I think that's where mistakes can be made. Okay, because as is said in this box, you use the Elliott wave to see where you are. Okay, you ask yourself, in this particular chart that you're trading, are we in a wave 3 or wave 1, which are the waves that you want to be, 1, 3, 5, right? Or this is the wave C that I want to trade. So you are basically identifying where in this phase of the market that you want to be, right? Because you really want to trade those waves that are more profitable, and where you don't want to trade as well. It tells you where you don't want to trade, right? But the alligator, if you use the alligator like a triple moving average, if it crosses that, you go on the long side of the market, or it crosses down, you go on the short side, then that is telling you when. Okay, the timing. So if you're using moving averages or using other types of technical tools, those are the when, those are the timing. Okay, but the Elliott wave is very valuable to tell you where, which part of the wave to trade. Okay, so this is a very important thing to remember. Right? So this box is very important. Okay, so when process of counting, always start with rule 100 to 140 bars context. Remember, okay, measure your bars. 100 to 140 bars will give you the correct context. After that, find your wave 3 first, because that's the easiest to find. Okay, and very easy to identify. From there, you can work through backwards to 1 and 2 or 4 and 5. Okay, and confirm it with the multiple tools. Okay, so that's the beauty of what we have now with technology, which Ralph Nelson Elliott doesn't have even his time. We have the alligator, we have awesome oscillator, we have this Fibonacci's that we can use to calculate very, very fast. Okay, they give you more accuracy to read. Right. So these are the important things, the key takeaways in terms of Elliott wave counting. Let's see what we have behind this, Naomi. Oh, actually, okay. So for your reading, if you want to continue your learning, okay, I suggest you read the Trading Chaos first and second edition by Bill Williams, of which a lot of these principles that you see tonight are based on him. I first learned about Elliott Wave in 1993, 95. Okay, that was the first time I read Trading Chaos by Bill Williams, his first edition. Okay, and he gave me a fantastic way of learning how to read Elliott Wave easily. Okay, before that, I read a bit. I gave up. Initial readings of all Elliott Wave was too complicated. Okay, so if you started with reading Frost and Proctor, which is the second book, the Elliott Wave Principle, you might give up. Okay, a lot of people might give up because the textbook is just, because it's so comprehensive, it's so academic, right? So you find it so difficult to apply. Okay, so I suggest you follow the same steps I went through. Okay, those actually helped me a lot in identifying waves. Okay, in fact, in 1996, 1995, I was working my first, I think second futures trading company, and I was telling the bosses then that in 1997, okay, we're going to see the KLCI coming down to the 500 and 400 level. Okay, so the boss was also quite shocked because I use Elliott Wave basically to project the correction of the KLCI. Okay, and that was the 1997 financial crisis. So I kind of like saw that in 1995, 96. So that's the beauty of, I would say, the forecasting tool by Elliott Wave. Okay, now what I'm going to attempt now to do, okay, this reading list, I'm going to try to attempt to see whether I can lock on back to, okay, then I'm going to try again to see whether I can share.
All right.
Okay, I hope you can.
Okay.
Hope the connection is better now. All right. I pray hard. Okay, it looks like we may. Do you see it?
Yes, I can see
Wow.
your screen.
Okay, got good luck. Okay, so I think my line is better now.
All right.
Okay, this is good. So now I can point to you where it is. Okay, let's go and bring out a chart. Let's see. We are lucky. All of us are so lucky. Okay. All right. So you can request some other charts as well, but let me find you a chart. Okay. Okay, right here. Let's look at crude oil. Okay, because just now you were studying all the up waves. So let's now studying the other waves. Okay, so the first principle is find yourself the 100 to 140 bars. Okay, so normally what I'll do is I click on the ruler. Okay, and go from here. I'll go back to say 100. Okay, this is about 140 bars. Okay, so I'm going to enlarge it. Okay, right. So this first principle, okay, get your 100 to 140 bar context. All right, and then, okay, look for the largest momentum wave. Okay, so what is the largest momentum wave now? Okay, right in this chart, you can see right over here, the AO, this is the AO. Okay, this is Bill Williams Awesome Oscillator. This is the largest. So this largest one with the wave 3 of a bearish wave. Okay, so this is the wave 3. Okay, so if we move back, okay, after you identify the tree, you can move back. Okay, so you can see right over here, this very big bulge right on the bottom here. This is the wave 3. Okay, so this is a huge wave 3. Okay, this is an hourly chart. Okay, from the origin point is at 93 right down to this particular point. Okay, so this is a wave 3. Then what is after wave 3? Wave 3 is wave 4, right? So wave 4 has to go above the 0, right? So it goes up, so it confirms it's wave 4, okay? After it confirms wave 4, what's the next wave? So this is the wave 5, okay? So wave 5, this is the last wave, okay? This is the last wave of this particular downtrend in the hourly chart, okay? So this is for the hourly chart dimension, okay? And for those of you who have questions, please put your questions in the chat box, okay? This is the perfect time to ask all those questions, okay? I hope you all have a lot of questions. I'm sure you have. This is such a not easy topic to talk about, right? Okay, so all your fans of Elliott Wave, do feel free to ask the questions. Hopefully that I've explained this well enough. Okay, let's go up let's look at daily charts. Okay. Daily charts. What are we looking at daily charts right now over here? Okay, so we look at look at the measurement. Okay, always start with that. We look at the measurement of how many days? 100 bars. Okay, at least 100 bars. Okay, so let's look at 100 bars right here. So we have a good context right here. And what is the largest wave in this box here? You can see the largest wave here is the wave 3, right? Okay, so this is the high here is the wave 3. Okay, now what wave are we in? Okay, we are in what we call wave 4. Okay, now we move back and see where is a possible wave 1. Okay, so the possible wave 1 is here. Okay, because we have where? Okay, we have this. What is this called? Okay, this is called if I draw it for you, this is called a bullish divergence. Okay. Okay, this is a bullish divergence. Okay, so this is point to a wave 0 over here. So in this sense, the high possibility of this is wave 1. Okay, and the rule, what's the rule? Okay, let's say, for example, if I draw you the wave 1. Okay, let's just draw a wave. Okay, let's see whether I can get that wave. Okay, it's here. Okay, so let's say right over here, if this point 0, this 1. Oh, wait, sorry. This should be 1. Let me adjust it. Okay, so this is wave 3. Okay, the high. Okay, this is wave this wave 2. This wave 1. Okay, this say wave 2. Right over here, wave 3. Okay, currently we are in wave 4, and then after wave 4, what we can project a wave 5. Okay, so the rule that needs to be followed, the cardinal rule. Okay, the wave 4 cannot go below here. Yeah, so this is the region danger zone. If it goes below here, then something is wrong with the count already. Something unusual is happening to the market already. So let me draw the horizontal ray here. Okay, this is wave 1. Okay, so you should see a lot of support coming around that level already, around the $70 for WTI. Okay, you should see a lot of support coming in already. Okay, because if this is going to be a valid wave 4, it should not come down to the wave 1 territory. Okay, or exceed the wave 1 territory. But if it does finishes this particular wave count, then the next wave is wave 5. Okay, that's basically what it's saying. All right, so that's on a daily chart. So on a weekly chart, okay, let me just remove this. Okay, so on a weekly chart, okay, so this is currently for the automated projections is wave 5. We saw that during our read just now. Okay, so this is a possibility of a wave 5, but this wave 5 bulge is very, very high. Okay, so this may perhaps start a new count. So it's hard to say. We have to see how this moves on. Okay, because this wave, depending on where in market, if it breaks through this, then it's not so nice anymore. Okay, so currently the wave count still stands for this particular read. Okay, but we will have to see where it goes. Okay, sometimes the count will invalidate itself, and then a new count will have to be restarted. Okay, let's see whether there's any questions. Naomi, are there any questions in the chat group? In the chat?
Let me check.
Hmm.
Can we get this slide? Yes, we will send the slide. We'll send a slide later after the session. Probably tomorrow.
Yes, we'll give you the handout so that you can go back and refer.
All right. There's no other questions so far.
Ah, really? Don't be shy, please.
Yeah.
Yeah, this is a chance to ask your difficult questions, okay? But for those of you, if this is the first time you've seen Elliott Wave, congratulations. I think it will open up your eye to what are the possibilities of using this particular method of technical analysis. It's very exciting to use it to forecast trends, okay? And see how the trends play out, okay? I mean, if you don't use it for trading, I hope you use it for trading so you can trade the best ways. But if you don't use it for trading, it's also good to kind of like, use it to see where the market is going to go. And I would like to say that all these charts are also applicable to all types of equities. If you are trading equities as well, right? It can be used on stocks, okay? Preferably stocks that are very liquid. But if you are trading US stocks, of course, those most of the US stocks in Nasdaq or in S&P and perhaps even in some more traditional stocks like Dow Jones, they will exhibit very classic Elliott Wave what do you call that formations, okay? Because basically Elliott Wave is a reflection of the market psychology. Okay, do you mind sharing the indicator? Yeah, so here you go. If you are here, let me show you. You go to the trading view. If you are on trading view, right? Okay, you go to technical indicators. You move to right at the bottom, right? You can see Williams fractals, but on top you have awesome oscillator. Where is that awesome oscillator? Yeah, there you go. Okay, so in the first part under A, you have awesome oscillator to measure the momentum. Okay, and you can use the alligator here, which is the 3 lines. Okay, alligator, Williams alligator. This is the 3 lines. Okay. Now, if you're looking at the automated indicator here, this is the, okay, if you're on, I think you need to be on Plus or Premium, okay, to have this Elliott Wave Absolute. Okay, this is an indicator that is from here. But it's not 100% accurate. It helps you to have a quick read, but you still have to confirm with your other Fibonacci, your other awesome oscillator ratios, okay? This is under, I think you have to, yeah, you have to type here. It's here, this is, yeah, this is called Elliott Wave chart pattern. Okay, let me see whether it's here in technicals and Elliott Wave chart pattern. Under E. No, it's for those who subscribe to Plus and Premium. If you are on the first tier, that one you may not have. I think if you're on essential tier on TradingView, you may not have, right? But you may not need that unless you want a fast and quick and dirty way to see Elliott Wave. Okay, it's better to learn the characteristics of it. Okay, let's now look at shall we look at, say, Dow Jones? Okay, there's one question here by Joshua. How long did it take you to get familiar with drawing Elliott waves? What advice would you give beginners who rely on the usual RSI, MACD, MA, moving average indicators and who want to try this out? Okay, so the advice just now I gave you was very important. Your usual trading indicators like RSI, MACDs, where you do the crossovers, whether it's a momentum or you're trading what do you call that, reversion to mean strategies, rangy trade, and all that, use the Elliott Wave to tell you where. All right. So if you are trading a method that is a breakout method, then you want to trade things like the impulsive waves. Okay. And if you want to trade rangy markets, okay, perhaps you like reversion to mean, you like the oscillating types like RSI and all that, then you will choose perhaps rangy markets, which are markets in wave 2 and wave 4, or some of the A and B trades, okay? But be careful as well. Those are not easy markets to trade, right? And how long does it take to get familiar? I think it takes a bit of practice, right? But using the method that you see here today, your ability to read Elliott waves are a lot easier, because you're using a lot of other confirming things. You're looking at the correct context. I think if you give yourself a good couple of months, okay, reading all these different charts, okay, download different charts, okay, you'll be able to get to the process. It's not about what you see here, but it's the process, okay, and then your eyes will start to be able to recognize the patterns already, right? So I'm so used to it. I look at a line chart just now. I show you was that bullish and bearish divergence chart. You can already see the Elliott wave there, right? But because of course I have a trainer, okay, but then I told you in 1993, 95, where I first started reading the book from Bill Williams, where he talked about the Elliott wave, I was able to predict at that time even the 1997 crash of what do you call that, the crash of the KLCI. Okay, so yeah, I think if you put in a bit of dedicated work, you can master it pretty well with all these tools that you have today. I hope that answers your question, Joshua. Right. Any other questions? Feel free to ask. Let's have a good conversation. Sorry, is there somebody talking?
Mr. David, there is one question in the Q&A session there.
I missed that.
All
How was
right.
it?
Okay. It's in the Q&A there.
Uh-huh.
With high frequency trading by machine prevalent now, do you foresee the Elliott wave and Fibonacci remain powerful too compared to when the Elliott wave is conceptualized?
That's a absolutely great question, sir. If machines are trading with machines, then how? Because we are saying that the Elliott wave reflects human what do you call that? Human psychology, right? And what a lot of people are doing are creating algos where what do you call that? Trying to remove the trading psychology part of it. Okay. I don't know. It's very hard to say. If AI moves beyond that, all right, it may make the reading either easier or tougher, right? But the large part of the markets are also still traded by human beings and algos which are created by human beings. Okay, that question is very hard to say, right? That's trying to forecast how good AI is. I have I like AI. Okay, let's not say I don't like AI. And the way it's going, it's so exponential. I think perhaps one day the character of the market will change. Okay, but remember this. Almost 3/4 or a big chunk of the U.S. Equity markets is traded by algos, right? But if you go in and look at the Elliott wave chart on algos, okay, on the equity markets, which are largely traded by algos, you still see the classic formations of the Elliott wave. Okay, perhaps there will be phases in the market that things will be overextended. Okay, because machines sometimes don't have perspective or less perspective than human beings. And think, sometimes in the human brain can say, hey, this is way overdone, right? But the machine will not say way overdone. They will just continue to do it. Okay, so sometimes you see those flash crashes in markets. Those are the guilty parties are those algos that continue not to think so well as human beings. Okay, but hopefully one day they can. I don't know really. This is a very, very futuristic questions. Okay, I like to see how that comes along and how it changes the Elliott wave as well. Okay, great question anyway. I hope
Thank you,
I
Mr.
don't
David.
really I don't really answer the question, but it's something that we want to witness. But thanks for the question. I appreciate that.
All right. Any questions for anyone?
Yeah, we still have another 4 minutes. Great to have some other questions. Throw some basic questions as well. Don't be shy. Okay, let me see whether I can stream my face. Yeah, please feel free and not be shy about, I think I can screen now. My internet is better now, my connection. Sorry about that first part. Okay, but we got through it fine. Everybody seems to be quite happy, which is good. Thank you so much. Can you see S&P 500 wave? Okay, Zakaria. Let's see. Huh? All right, let's get the S&P 500 on. Okay, so let's go and look at the okay. Let's look at the daily first. Okay, I don't want to distract you with this absolute. Let's cover it up. Okay, let's reset chart view. Okay. Now, obviously, this particular move here. Let's take the context. Excuse me. Let's take the context. Okay, let's do it here. Okay, around 111, 100 bars right over here. Okay, so the biggest bulge now is this bulge there, which is the okay, this particular move looks like a wave 3 within the daily chart. Okay, so and now it's gone to negative right over here. So this is possibly now a wave 4. This is a wave 4 move. Okay, and this backup, this move over the last couple of days could be looking at a wave 5. Okay, so my read now at this current moment that this is a starting of a wave 5. Okay, so okay, so we may still see some upside still. Okay, for this S&P. Okay, so we have a wave 3 here. Okay, so let's look at the momentum. Let me show you this in. Okay, so this gone to zero, below zero. So this confirms that this is a wave 4. Okay, now has gone up and taken up the wave 3 high. So this is wave 5 now. Okay, right over here. So how far this wave 5 will go, we will have to see. Okay, and let's look at with this is daily chart. Let's look at weekly. Okay, so weekly, you can see right over here, this is wave 3. Okay, this is also wave 4 already. Okay, this is the wave 5. So that was the wave 5 of the wave 5 already. Okay, so we have to see whether this actually can okay. Now, this particular read right over here, okay, in my original assertion was this is a 4 and this is a 5, okay? So now we will have to see whether this particular one is a what do you call that? What we call a irregular correction, okay? So here we have to see how it plays out first, okay? This can have a characteristic of two things. It could be an extended 5, this is the last part of it, okay? Or it becomes an irregular correction, okay? So we will have to say, unless we say here 1, 2, 3, there is already an A started, okay? And then this is a B, okay? This B of a react. We have to see. So that is a bit of the subjectivity of especially when it comes to a corrective part of a possible corrective part, okay? But if we just read it off here, okay, okay, if we just read off here, it could be the last wave, or it could be a wave 5 within the structure that we're looking at, okay? The Dow Jones is perhaps a bit clearer. And let's bring out a Dow Jones, because sometimes if you see it not clear in other charts, go to the other charts which are correlated, okay, to see. Okay, so in so we have a bearish divergence over here. So basically it's saying that this is 5. Okay, this is 5. Okay, so this is something that we have to define, whether it's another extension of this particular 5 or a irregular correction. Okay, I hope that gives Zakaria a bit of a read on the equity markets. Okay, I think it's now time to, although some of the highs in the US equity indices could still have a bit of room to move, okay? But things are so liquid in terms of the Middle East peace or ceasefire or MOU. You have to be really light on your feet. Okay, so if you are trading, say the E-minis or the S&Ps and all that, you will have to watch your risk properly. Okay, you have to act very fast. Okay, probably don't go to too high level charts because each of the movement is very volatile. Right, if you trade probably 30 minutes hourly charts, I still think you are what do you call that, manageable, because if I go in and look at the 30 minutes, see this chart is very, very different already. Right, so if I just look at the wave structure, is a it's a lower high, lower high. Okay, and see, you can see so much volatility right here in this bar as well over the last half hour. All right, so I wish you all the best. Do be careful. Okay, hopefully this tool in Elliott will help you all to sharpen up your trading. Back to you, Naomi.
All right, let's see any questions. So, all right, I think there's no more question.
Good. Everybody's happy.
Right. So if there's no more questions, we'll end the session here. Right.
Thank you so much.
Again, all right. Again, a big thank you to Mr. David for sharing so many valuable insight with us today. All right. Thank you, Mr. David, and
thank you
for taking the time to be here. I'm sure everyone has learned something useful from today's session. And of course, thank you to all of you for spending your evening with us. We really appreciate your support and we hope you enjoy today's webinar. And if you'd like to stay updated on our upcoming webinar, promotion, and market update, don't forget to follow Weibo Malaysia on Facebook and Instagram. Right? That's all from us tonight. Have a great evening. Take care, and we hope to see you again in our next webinar. Yeah. Bye,
Bye-bye.
everyone.
See you all. Bye.
Bye.